Okay.
All right, pushing us live now. And we are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your Money Show host for this session. Glad to have you all here. We do have Mike Larson and Peter Boockvar here in the Zoom room with us, ready to begin their fireside chat on time at 9:30 a.m. That's Eastern time coming up in just a few short minutes. Hope you're all having a wonderful morning and looking forward to enjoying the show today. Hello again, and welcome to those of you just joining us. This is your Money Show host speaking. Just wanted to let you know that the next session will begin on time, or the first session, I should say, should begin on time in just a couple of short minutes at 9:30 a.m. Eastern Time. Thank you for your patience. Hello, everyone, and welcome. We are joined this morning by Money Show's editor in chief, Mike Larson, along with Peter Boockvar of One Point BFG Wealth Partners. It's a pleasure to have you both here, gentlemen. And without further ado, Mike, I will hand it over to you.
Wonderful. Thank you, Charlotte. Welcome, everyone, to the Money Show Investing and Trading Summit. I do appreciate you taking some time out over the next couple of days to join me and our experts on the Money Show platform. And I can promise you it's going to be time well spent. You're going to enjoy a dynamic mix of macroeconomic and geopolitical outlooks. You're going to have sessions packed with stock and ETF picks. You're going to get briefings on options and commodities trading. And you're going to get some details on alternative investment opportunities that are kind of tailor-made for an environment with more volatility and people looking for a little bit of alternative help with their income generation. Also, please don't forget this event is fully interactive. Our experts aren't just going to be talking at you, they're going to be here to take questions from you live. There will be a chat box on there. If you type it in, our moderators will make sure that it pops up on my screen so we can address your questions and comments during these sessions. If you aren't aware, we have also revamped the virtual expo format. It's going to give you some more in-depth sessions over the course of the next 2 days. That includes Steve Reitmeister's hour-long class using AI to improve your stock picking. That's scheduled for Wednesday at 4 p.m. Eastern. So again, a little bit of a different format, giving you some more in-depth sessions, and of course, keeping the interactivity that makes this all worthwhile. I frankly probably don't need to tell you how helpful expert guidance can be in a market like this one. I mean, this is an environment where every headline and really every tweet is fueling huge moves in stocks and oil prices and other assets. So that creates some challenges for long-term investors, creates some opportunity for short-term traders, and frankly, let's be honest, it probably helps all of us grow a few more gray hairs. So with that preamble out of the way, I want to get the summit started and introduce my fireside chat guest today. As Charlotte mentioned, he's Peter Boockvar, Chief Investment Officer at One Point BFG Wealth Partners. Peter is also editor of the Book Report, which is a macro market email newsletter, newsletter as well, that I read each morning, and I recommend you do too. Earlier in his career, Peter also served as chief market analyst at the Lindsay Group, macro analyst and portfolio manager at Omega Advisors, and partner at Miller Tabak and Company, where he was the equity strategist and portfolio manager. Peter, welcome to the event.
Thank you, Mike. Mike, I don't see any gray hairs on you yet.
I don't know. They're hiding in the back. Maybe it's the
Okay.
light. We're not sure, but it's been a market that I mean I don't know how it's crazy to think that again we've had headline driven markets in the past, but tweet driven markets, whatever this in this sort of Trump 2.0 environment has really been amped up, especially given the geopolitical events of the last several weeks. So why don't you start by kind of setting the stage with what you're seeing big picture, and then we'll dive into some of these individual issues and potential names and sectors.
All right. So we'll take a step back and get into March when, of course, the war started and we saw the spike in oil prices and we saw the big pullback in the markets. I think the markets bottomed right when the White House started to signal that they were done with this. I think once it became clear that the regime was not going to change, no amount of bombs were going to do that. The closure of the strait and reopening of it became the main focus. And since the end of March, when stocks bottomed, the market has been on this sort of hope trade that we're going to end this, the straits can reopen, and supply chains are going to normalize, which I'm still optimistic that that's going to be the case, and hopefully this week. The problem, though, is that each day that goes by where there is not a full reopening, the supply chains keep getting more clogged up. And rather than talking about the price increases of a variety of different commodities,
Yeah.
we're now talking about volumes, and we're talking about shortages, and we're talking about jet fuel running out in Europe in 6 weeks, and we're talking about issues with medical supplies and aerospace components that can't be shipped on through the air because we're running out of jet fuel, and what it means for petrochemicals because naphtha comes out of the region, and we know helium and nitrogen and so on. And that's the big problem here. Now, I'm confident, as I said, that this is going to end. We'll get a pullback in commodities, but it's still going to take months to normalize.
Yeah, and I mean, I think the way you sort of frame that is how broad this issue is. I mean, in the past, we've had disruptions on, small scale conflicts that shut down oil and gas supplies from some certain country, but you can make it up elsewhere. But here, we're not just talking energy; we're talking all those sort of ancillary gases, and other products, fertilizer, and so on. So, how if this thing drags on, and as you mentioned, your main scenario is that it won't. How does that filter through, whether it comes to not just shortages, but, inflation, commodities driven inflation, and so on over the next several weeks?
Well, if it continues for the next couple of weeks, and even through the month of May, we're going to be talking about COVID-like shutdowns. And it's not just, okay, we mentioned jet fuel. It's not just, okay, people can't travel somewhere, but there's an enormous amount of stuff that gets shipped through the air, in the belly of a plane. And just the US and what we get from Europe, for example, I mentioned aerospace components, we get pharmaceutical products and a variety of other medical supplies. that aren't going to be able to be shipped here via plane and is going to end up being sent over by ship, which obviously takes much longer. So, and I don't want to exaggerate too much, but when I say COVID-like shutdowns, I'm literally talking like COVID-like shutdowns if this continues for many more weeks. Of course, the price of everything then goes up, which is already beginning to happen. We saw that in the March PPI and CPI, even though some of the numbers weren't as hot as expected, they
Yep.
still rose notably, particularly on the headline level. And also, with the price of oil going up and using that particular commodity, it takes months for it to filter into other things. An example, WD-40, which reported earnings last week, they rely on chemicals and petrochemicals in their products, and they said that it can take 3 months before it starts showing up in their cost of goods sold, and then of course there's going to be a response by them, probably via price, maybe not one for one, but the price increases are still to come with these prices that are elevated currently, and a variety of different products. I mean, the shirts we're wearing use petrochemicals. Naphtha goes into making ethylene, which is used as a core part of petrochemicals, which is used to make polyethylene, which goes into plastics and
Right.
packaging in addition to clothes. So, if you can't package something and you don't have plastics, there are going to be factories that literally shut down. So, that's why I think we're going to get a deal of some in some way, whether it's good or not, because the strait has to reopen for the sake of the global economy.
So let's say that those pressures just, forced some kind of deal to be made between us and Iran and whomever, and Israel, stops attacking. We get a some kind of truce, some kind of ceasefire that lasts and holds out of this. Can you talk a little bit about where we were in terms of the economy and markets pre-February 28th and what we kind of will go back to if that does happen, whether it's today, tomorrow, next week, what have you?
I think it's an important question because the war will end, the strait will reopen. In 2025, GDP growth averaged about 2%. Q1, according to the Atlanta Fed, is estimated to be about 1.3%. And that's, of course, 2 months pre-war, 1 month with war. And then in Q2, the acute impact of it, obviously globally, will be more pronounced. So there are a couple of things that I think we're going to be back to focusing on. We're going to be back to focusing on the state of the AI tech trade. That was, to me, one of the more notable things. If we look back at the end of 2025 and certainly the first 2 months of 2026, the Mag 7 trade started to dramatically lag the rest of the market.
Yeah.
And I think that is because the market has begun to re-rate these companies, these hyperscalers that are spending all the money to build out these models and the data centers and so on, to the point where their free cash flow is deteriorating significantly. Oracle and Amazon will have negative free cash flow estimated this year. Meta's free cash flow expected to go from about 45 billion this year down to 8. Google, $75 billion of free cash flow last year, expected to go to about 25 billion. I mean, those are big changes, and I think the market is re-rating them multiple wise. Now, the receivers of that spend, semiconductors, we know NVIDIA and the storage and memory names, they're doing fine.
Yeah.
But even NVIDIA stock, no higher than it was last October. And until this run over the past couple of weeks, it was no higher than it was in August because people are wondering what is the sustainability of their 75% gross margin in light of the growing competition with Google's chips, Amazon's chips, and certainly the lack of access to China's market. So I think we're going to go back to focusing in on that in terms of figuring out what's the benefits from all this spend. Also, one of the other things, of course, we talked about a lot was private credit
Yeah.
and what that means for the financial system. I don't think it has systemic impact on the financial system, but I do think it's going to have a notable impact on the cost of capital. Private credit, we know, filled a big vacuum that was left by the banks that provided a lot of credit for those that needed it, but some of it, a lot of it was though just financing private equity deals.
Yeah.
So I think that's important for people to understand. But I think net net, the cost of capital is going up again for private equity, private credit deals, and that can then filter into the cost of capital for businesses broadly. So that's another thing that I think we'll go back to debating, and also how the global economy recovers from this supply shock. And it will recover. It's going to take time. There are going to be pain points. There are going to be lost things on the shelves for a period of time, but we will normalize. And one last point, and then I'll throw it back to you. Market-wise, one of the big changes in 2025 was the dramatic outperformance for the first time in 15 years plus in international markets relative to the US. A lot of that coincided with the weak dollar. That trend continued in January, February, reversed in March, of course, because the dollar rallied and investors sold off sharply those countries that were heavily dependent on imported oil. So I think we're going to go back to actually continuation of the weakness in the dollar and outperformance as international markets, particularly in Asia and Europe, recover from what has happened the last month and a half here.
Yeah, there's a lot of material there to unpack, and I appreciate the big, sort of setting the stage, big picture there. One thing I wanted to zero in on first, though, would be, your talk about it being an issue, private credit being an issue for companies and lenders that are directly levered to that part of it, but not maybe the financial system as a whole. And I bring that up because we've obviously seen the big banks, the JP Morgans, the Goldman Sachses of the world report some pretty stellar numbers for Q1. Do you think they're going to be able to hold up? Do you think that what has happened to the BDCs and some of these private credit companies will stay contained? I mean, that's sort of the old expression, the well contained, which came back to bite Ben Bernanke. I'm wondering, you don't seem to think this is one of those type of situations, correct?
Well, the banks in particular, the big money center banks, they certainly benefited from capital markets business in Q1. We know when the markets got really volatile in March, that was a boon to that side of the business. Now, bank exposure to the private credit is via lending, creating warehouse loans for these non-depository financial institutions. I do think all of those, the banks, both money center and the regionals, are now more heavily scrutinizing the further extension of those loans,
Yeah.
and also really scrutinizing because the loans are the collateral the private credit loans are the collateral for the loans that these companies are receiving from the money center banks. So I know the money center banks and the regional banks are now more scrutinizing the loans that private credit is extending to their customers to make sure that the banks are fully protected. So I'm not really worried about the banks. And we're going to go through a default cycle at some point. That's the one thing about the current iteration of private credit because pre-GFC, we did have business development companies. So
Yeah.
it's not a new thing for the private sector to be lending money and financing private equity deals. But and keep in mind again, that's what a lot of private credit is. It's funding private equity deals where those private equity firms need to raise money to finance the purchase of the businesses that they're buying. The other area of private credit is where banks, or I should say, these funds are directly lending to a company that wants to build a factory, wants to build a distribution center, or hire more people, or go overseas, or whatever.
Okay. Do already have a couple questions coming in, and I want to get to those in a minute, but I did have to ask also about the big issue, and that's the AI. Are we borrowing too much? Are we spending too much? Is this, are these investments, these mega investments that companies are making, going to pay off down the road? And you mentioned that Wall Street will be asking that question. How would you weigh in on that? I mean, what are your thoughts based on what you're seeing in that particular part of the markets?
Well, considering the size of the investments, and just to quantify that, in 2022, Oracle's CapEx relative to revenue was 10%. Now it's 75%. You look at Meta and Microsoft, CapEx as a percent of revenue was in the low teens pre-2022. Now it's like a third to even more. So and Amazon is now spending half their revenue on CapEx.
Yeah.
So to get a return on that, the bar is extraordinarily high. And when you are now making these models, it's becoming extremely competitive. And US tech is not just competing against each other. They have what I believe is the most competitive threat to their not necessarily their business, but to the commodity like things that they're creating now is the Chinese. The Chinese are creating their own models, and a lot of that's open sourced. So while China may not necessarily gain market share in the US versus US models,
Yeah.
but the rest of the world is their oyster. If you're a small company in Germany or in Singapore that's bootstrapping it, that needs to subscribe to somebody's LLM model, well, China, if they can create a more tailored, bespoke, cheaper model than you're going to get in the US, well, you're going to use them because you need to save money and you're a small business and you're trying to get off the ground. So China is a major competitor to US companies, both on the AI side, model side, but also growingly on the chip side. They are creating their own semiconductor industry and software industry. So I think that that's just something that a tech investor needs to think about in the years to come.
Okay. Let's talk about the third issue that you brought up, and that's the falling dollar and the outperformance that we saw last year and up until the war happened in terms of foreign markets relative to U.S. You think that we're probably going to go back to that? Let's say that the war ends tomorrow, what have you. You think that trend will probably shift back then? How long do you think that lasts? I mean, is that a Q1 and Q or a Q2 story, or is that something you think is maybe for the next couple of years?
Well, if I'm right that the market defined as the S&P 500 is potentially losing the leadership of the Mag 7 stocks for the reasons that I just gave, well, then that is the opportunity for foreign markets to outperform. Because the main reason why US markets dominated for the last 15 years is because of US tech and these companies in particular that at the peak had many trillions of dollars of market cap each. If these companies now start to lag because of the focus on free cash flow deterioration and maybe markets saying I'm not going to pay that same high multiple anymore because of that, well, that is the opportunity for overseas markets to outperform. And if the dollar, which obviously was weak last year at its worst first half of last year since the early 70s, if that dollar decline starts to resume itself when this war ends and the strait reopens, as the theme of capital and trade flows that are now more interested in diversifying away from the US, well, then that also potentially is another help to international markets relative to the US.
I'm about to shift to a couple of the questions, but one last thing that I know I've been asked about at events recently, and I know is probably on the minds of people watching this, is the market impact or economic impact of a potential policy shift. We have the midterm elections coming up. Based on the polling, it looks like maybe the House and potentially the Senate may flip. From a markets and an economic policy standpoint, how do you think that impacts things? How do you factor that in, when you're looking to sort of allocate capital here?
Well, from a legislative perspective, it's not going to matter because we'll still have a split government. But you're right, the Democrats will certainly take the House, and we'll see what about the Senate. But because the presidency obviously is still Republican, very much so, legislatively, you're not going to get much of a change. The question, though, is on the flip side of fiscal, is monetary, of course. And on the day we're doing this, Kevin Warsh is in front of Congress for the first time since he was nominated to tell us what he thinks. I do think while he's going to be pressured to cut rates, uh, the reality of the macro environment, certainly the new reality post-war in terms of oil prices and other energy costs and other commodity prices, what that means for his job is much more complicated. We entered today with the Fed funds futures market looking through the rest of the year, so through December, pricing in just a 44% chance that the Fed would cut once. Before the war, we were pricing in 100% chance of two. So it was almost a lock that we were going to get that.
Yeah.
And even if Kevin does want to cut rates, he still has to convince the rest of the committee. And at least for now, the rest of the committee outside of Michelle Bowman and Chris Waller, even Chris Waller, though, is pulling it back. They seem to be more interested in sitting and waiting to see how things play out instead of jumping the gun and responding to the current environment. Now, it will get even more complicated if the labor market does start to further weaken here and the Fed chair is left with a rising unemployment rate at the same time inflation is remaining well above its their 2% target.
Okay, now let me shift. Nicholas Walsh chimed in and said, "Can you address your long-term view on precious metals? Obviously, probably given what we said about the dollar and potential interest rate market moves, that's going to impact things. So, where do you stand on gold and silver and some of the related equities?"
So I think well, we know gold and silver, particularly silver, late last year, early this year, just went parabolic. And silver in particular, which we had owned for years, I sold almost all of our silver because I know a straight line up chart when I see one. I'm sure you do
Yeah.
as well, Mike. So I think we're in the consolidation and digestion phase of that move. And then, of course, you throw in the strong dollar in March and every short dollar, long non-dollar assets like gold and silver, like international markets. Well, then we had a reversal of that. So when the war does end, I do though think we have the benefit of the bigger picture trends of a world that wants to diversify away from US dollars. And particularly those countries that are trading in non-dollars, like China buying their oil from Russia in yuan, buying their oil from Saudi Arabia in yuan, buying their soybeans from Brazil in yuan, that and those countries then taking that yuan and then in turn buying stuff from China and whatever leftover there is, it's going to get recycled into gold. Whereas when a lot of these transactions were taking place in dollars, China would just recycle them back into US treasuries. So I do think that the importance of gold as a reserve asset right now still is very much intact. And I think the bull market will sort of resume itself. When that will be, I'm not sure. How much longer this digestion phase takes place, I'm not sure. But I'm still pretty bullish on precious metals. But again, telling the audience that we had sold our silver, most of it, in the early part of this year on that parabolic spike.
Yeah, I mean, you're absolutely right. I don't care what the asset is when you see a move like you saw in January, in metals or anything really. That really was definitely, in my opinion, kind of an intermediate term blow off move. And now you just sort of see what happens after the digestion. I do want to, I guess, while we're on the subject of commodities, talk about non-oil, some industrial metals, other things. I mean, what happened, in your opinion, are there opportunities in things like copper and things like other industrial metals or non-precious parts of the commodities world or non-energy parts for that matter?
Well, energy. So we've been long energy for the last couple of years, and got particularly bullish in the first part of the year before the war. Now,
Yeah,
I was not betting on the war. I had no idea, no one was no one had a crystal ball like that. But there were a couple of reasons when oil was $60 to $65. I was arguing that it was one of the cheapest assets in the world, and we added to our oil stocks. And also, you had the U.S., which was over the last 15 years when U.S. oil production went from 5 million barrels a day to nearly 14. The U.S. was the biggest non-OPEC plus swing factor in terms of production. But if you look at oil production out of the US, it's flatlining. And you
yeah,
look at oil production, a lot of some key basins in the US, it's actually rolling over. So I said that's pretty notable with oil sitting at $65. That doesn't seem to be a price that reflects that reality. And demand still seemed to be pretty good. There was talk about all this, the glut of supply, but the glut was really just on the water, on these sanctioned ships. It really wasn't showing up anywhere else.
yeah,
And so we got long. And then, of course, you had the war. And then that begs the question, okay, what do you do now? Now, when the war ends, oil prices are going to pull back. But, I'm of the belief that 80 to 85 is the new 60 to 65 because when this war ends, yes, a lot of supply chains are going to normalize.
yeah,
But, you're going to have global strategic reserves everywhere in not just accumulating and hoarding more crude oil, but natural gas and fertilizer and copper and zinc and silver and anything that potentially is at a supply point, choke point, that somebody can do something and you may not be able to get your stuff. So I'm bullish generally on commodities. 2025, we had the industrial metal, precious metal bull market. That, of course, is now spilled into energy. And I do think probably in the summer before the harvest season begins in September, October, it will eventually get to ag because of what's going on with fertilizer prices. So I do think we're in a full-fledged commodity bull market that it's going to last a couple of years, and then of course is going to complicate the rate story and inflation story and so forth.
Got it. Just a reminder to anybody watching this, if you do have any questions, do type those into the chat box during this session, pretty much any of the sessions over the next 2 days. We want to make sure we get your questions answered as we can on the platform. But in the 5 minutes or so that we have left, Peter, you said you're willing to throw a couple names out there. Maybe given some of the themes you've talked about, what would be an ETF or two or a stock or two that would allow somebody watching this to capitalize on some of your key themes?
So mentioning that we're long commodity stocks too. My other group that I really love that I argue is probably the most hated group in the market, and that's consumer staple stocks, particularly
Okay.
food and products. An example, we own Kraft Heinz. This is not investment advice. There are 22 analysts that cover Kraft Heinz. One has it as a buy. We have a new CEO. This company lost market share for 10 straight years, and the CEO said, no more. We're going to spend $600 million and we're going to invest in our brands. We're going to innovate. We're going to improve the quality of the food. We're going to improve the packaging. And we're going to let people know that we still have great products and iconic products.
Yeah.
So I do think that that is a very interesting turnaround with the stock trading at about 9 times earnings with a dividend yield of 7%. Conagra, that has 17 analysts covering it or 18. One has it as a buy. They are the largest frozen food company in the US. You can imagine people searching for value and convenience. I think that's a pretty attractive place to be in the food business. And they also have a nice beef jerky business with Slim Jim and other snacks businesses that generate some pretty good cash flow. They're paying down debt and they have a brand new CEO that's about to start. The previous one had an 11-year tenure, so they were in the process of making a transition. So I think that these stocks have just basically been thrown out the window. These companies are not sitting still. They understand the new reality of the focus on health and wellness, GLP, and whatever. And I do think that these are going to be interesting turnaround stories and obviously cheap and left out in the trash because of the amount of buys that are on both of them. And then Kimberly Clark, another example. So I think that sector with very cheap multiples and very generous dividend yields that I think are interesting turnarounds.
Okay. Regarding the foreign markets theme, is there a particular country, region, that you think has more promise, or is it just essentially a field bet against the dollar you think is going to work out almost no matter where you invest?
So ETF wise, we're long Brazil, Singapore, Vietnam, Hong Kong via China, and also India. And stock wise, we're long a bunch of stocks in Europe and also in Asia. I think Asia, looking at over 10 years, is probably the most exciting economic growth story in the world with a rising middle class there. So I do think that, and I'll leave it here, and people have to understand that 75% of the world's GDP takes place outside the US, and 96% of the world's population lives outside the US. I think being an investor in today's markets, you really need to look at the world in totality and not just think that there's seven stocks in the US or just big cap tech in the US are the only ideas that you can possibly have.
Got it. Well, I think we're pretty much at time here. There's some great advice there to wrap up with. Peter, thank you so much for taking some time out. Viewers, if you're watching this, again, foreign markets, potential plays in commodities, maybe a blow off that needs to be digested in the precious metals part of that space. But energy, not just for what happens after the war premium, some of it fades. Sounds like Peter thinks not all of it will, and that there's opportunity there. So definitely keep those ideas in mind. Peter, thanks again. Good talking to you, and
Thanks,
look
Mike.
forward to
You
the next
too.
event.
Thanks.
Yeah, thank you both for a great session. And to those of you watching us live, thank you for joining us. And be sure to stay tuned as we have a lot more in store for you at this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.